I'm John Hanna for CDTV.net in New York, and we have Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. Hey, Dirk.
Hey, John, how's it going?
Great, great, great. And yourself?
Oh, not too bad.
So, Dirk, we're at the end of our quarterly reporting cycle. What are your thoughts about it?
It was really a very solid cycle. The total net income for the S&P 500 was up 30.7% from a year ago. When we were just going into the earnings season, the expected rise in total net income was slightly less than 20%. So that's a remarkable, better than expected. When you look at what the median surprise was, it wasn't quite as impressive. The half of the firms produced earnings that were 3.64% above what was expected. That's kind of a normal amount, but effectively the biggest companies, the most profitable companies, were the ones with the biggest positive surprises, which led to that difference in the total net income. Now, an awful lot of the positive surprise actually came from the financial sector, where banks just simply were writing off a lot less bad debt than they were a year ago. So if you pull out the financial sector, we were only up 19.9%, which is roughly what was for everybody before we entered the earnings season. You had more than 3 times as many companies reporting positive earnings surprises as negative surprises. And things on the top line were pretty good as well, up a total of 8.24% year over year, or if you strip out the financials, up 8.77%. I mean, which implies some really impressive growth on net margins. And particularly in the financials, because writing down bad debt doesn't affect the top line, bottom line. So the overall net margins for the S&P 500 were 8.98%, or almost 9%, up from 7.29% a year ago. And if you strip out the financials, which again, revenues are a bit of a trickier question with financials and have a little bit different meaning. Then you had net margins of 8.33%, but that's still up from 7.38% a year ago. So in other words, the lion's share of the growth in earnings has come from better net margins. Sales doing okay, but nothing like earnings. People should keep in mind that these are net margins, i.e. after-tax margins, that are simply exploding to the upside. I mean, if you sort of take a look at this progression of where the net margins have been coming from, and for the full year, the S&P 500 in total was 6.40% in 2009. That rose to, for all of 2010, to 8.58%. For 2011, it's expected to grow to 9.57%. And then in 2012, the projections are for net margins of 10.25%. I mean, that's just massive. You strip out the financials, the progression's a little bit less intense, but still growing. 7.09% in 2009, up to 8.23 in 2010, 8.80 expected for 2011, and 9.31 for 2012. So, we're looking at a massive expansion in net margins, which makes all these complaints about how much, we're overtaxing corporations really, really hollow. I mean, when you hear somebody talking about that, your reaction should be, guffaws of laughter rather than rapt attention. And you can also see that in the percentage of GDP that the federal government is collecting from corporate taxes. It's now near an all-time low, less than half the average that it's been since 1947. So anytime you hear these corporate executives talking about how high corporate taxes are, pure crocodile tears. And so, but getting off a bit on a tangent there. But, the net result was a very strong earnings season, and one that's basically expected to continue, although we have, much higher comps going forward. So the growth rate is definitely going to slow. For all of 2010, total net income was up 45.1%. Obviously, we're not going to compound at that rate forever because, it was coming off of pretty lousy earnings in 2009. But for 2011, we're still looking at 14.6% growth, and even stretching out into 2012, 13.4% growth. That is, pretty solid growth. And over time, especially when you sort of compare to the overall growth rate in the economy or the level of interest rate, the PEs are very reasonable, and keep in mind that we're talking about the PEs as of the close last Thursday here, and the markets have dropped rather substantially due to the news out of Japan since then. But based on trailing earnings, 2010 earnings, we're only at 15.5 times, and if you look out to the expectations for 2011, it's down to 13.6 times, and we're trading for under 12 times 2012 earnings. That's pretty reasonable in the context of 10-year Treasury rates of under 3.4%. We're still seeing solid growth in earnings, and really that's what you buy stocks for, is for their earnings potential and therefore their potential at some point to be paying dividends. And so the earnings picture looks very, very solid. Obviously, there are all sorts of major macro concerns going on with recent world events, but if one were just looking at how are U.S. companies doing right now and what are analysts expecting, things are looking very good. Analysts are still raising about 3 estimates for both this year and next year for every 2 that they cut. And so one has to, when one sees that estimates are going up, one should sort of treat the current estimate as kind of the minimum, and the probability is that the earnings are actually going to turn out to be higher than that they look like. Conversely, if estimates are being cut, one sort of should conclude that estimates are going to continue to be cut. So, we're looking at really massive amounts of net income. If you look at how much the 500 companies in the S&P 500 collectively have earned, that's going to rise from $545.3 billion in 2009 to $791.3 in 2010, rising to $906.5 billion in 2011, and we mark in 2012 to $1,029 $28.3 billion. That's a lot of money, and that's a lot of growth. I mean, we're talking between 2009 and 2012, almost a net income of the S&P 500 firms. That's, by my book, very, very impressive. And I think that there's still some pretty good values in the market, provided that we don't really be forced back into a recession due to global events. The events in Japan are going to have a major dampening effect short-term on world economic growth. I mean, there are an awful lot of set of components that go into products that are made elsewhere that come out of Japan in a just-in-time inventory world, which is actually something that the Japanese pioneered. The economy is much more vulnerable to these sort of supply disruptions. So there is going to be a negative effect coming out of there, at least in the short term. Also, all those Japanese insurance companies are going to have to repatriate funds into yen, and then sell off those assets to pay the claims. That puts a downward pressure on the markets out of a sheer flow of funds things. The central banks are loosening up. Japan sort of did its version of QE2, almost actually relative to the size of the Japanese economy. What they announced in reaction to the tsunami is almost identical to the $600 billion QE2 program that the Fed has put in. I wouldn't be surprised if that goes up some more. And I think that definitely there's no question now that the Fed will complete the QE2 program, given this sort of negative liquidity shock from the disaster in Japan, and actually might even raise the prospect of a third round taking place, although that's still less than a 50-50 chance. But there are an awful lot of concerns that we would lead to some overheating and inflationary concerns if we continue down that path. But the immediate reaction to the quake is essentially a deflationary, slowing one, but later on, right? All those cars that you saw floating in the tsunami and all those buildings that get destroyed, presumably they are going to have new cars and buildings rebuilt that will actually tend to increase demand over time, but that's a little bit later down the road. Now, yes, statistically that's going to show up as higher GDP growth for Japan. It doesn't mean that Japan's going to be better off, right? And they're just sort of replacing what they had lost. And the estimates I've been hearing are in the neighborhood of $200 billion worth of direct losses. Other short-term depressants on demand is, they don't have much electricity right now in Japan, and so all the factories have to be shut down to try and prevent continuous rolling blackouts. Clearly, the 4 reactors that have been damaged, those are gone for good. But, and then you've got a lot of other damage to the transmission infrastructure, other sort of conventional plants that just have a whole bunch of cracked pipes and stuff like that will be fixed, but not right now. All that's going to be big presence on demand. Just think about it in terms of steel. Steel uses a lot of electricity to make it. So any Japanese steel plant is probably being shut down right now to save electricity, even if it was in a part of the country where nothing was damaged. But, so that's going to depress demand for metallurgical coal and iron ore and things like that. But, later on when you start to build those cars to replace the damaged ones and to rebuild the buildings and the roads and bridges and all that stuff that were wiped out, that's going to be higher demand for it. So what I think we're going to see is a short-term depressing of demand, and that's going to be worldwide. Obviously dramatic in Japan, but it will flow around, but the rest of the world. But later on, you'll have some picking up of the slack. And in terms of the overall economy, since Japan is a net exporter, right, its slowdown isn't really going to be a net pull away from the rest of the world, right? Because their surplus means a deficit to somebody else, most of the time the U.S. And so if that goes down as a result of this, that might actually start stimulating the U.S. economy. But, down the road, probably you're talking second and third quarter, not in the first quarter. So there are a lot of cross currents in how this is going to affect the markets and the economy. Certainly has raised uncertainty, and that's part of the reason that the markets have gone down in response to it. But the earnings picture is still very much intact, and the valuations are very reasonable relative to long-term interest rates. And I would say that the odds are still that we are going to end the year significantly higher than where we are right now. Not huge, but I'm still looking for a end of the year S&P 500 level of around the 1400 level, which I think would be a fair price for the S&P 500.
That's Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio, and I'm John Hanna for CDTV.net in New York.